Economic indicators, including data released by government agencies and independent research agencies, are key pieces of information that help traders gauge movements in the market. Here's every important economic indicator. Starting off, we have GDP, or Gross Domestic Product, which is a measure of the total value of products produced, usually in a year, of a country, used for gauging the overall size and growth of an economy. Next up is CPI, or Consumer Price Index, which is a value calculated through the weighting of a basket of many different goods and their prices. It measures overall change in the prices of goods, or in other words, inflation. Another indicator for inflation, albeit much less anticipated and considered, and the inverse of the Consumer Price Index, is the Producer Price Index, which, as its name suggests, measures the prices of unfinished goods that producers of finished goods pay. Similar to the Consumer Price Index, these prices are of a basket of different goods. Yet another indicator for inflation is the ECI, or Employment Cost Index, which is based off of a quarterly survey of employee payrolls by certain employers. The next indicator of inflation is the Import Price Index, which is based on the prices of a basket of imports. Similarly, the Export Price Index does the same, but with exports. Finally, while the price of crude oil may seem to be out of place on this list, due to the sheer volume of how much crude oil is consumed per day, and the idea that the price per barrel of crude oil is heavily US dollar denominated, it is still an important indicator that many traders use to gauge the buying power of the US dollar. Gauging inflation is key for understanding the ability of an economy to maintain a stable market. It can also be used as an indicator of whether or not there would be governmental regulatory changes based on inflation which could directly impact commerce. One of these indicators based on inflation, though less of a statistic than a rule, is the Federal Reserve Rate. I have an entire video on the Fed rate linked below and or on the screen, which delves deeper into it. Though, in simple terms, the Fed rate is a yearly adjusted rate at which banks can lend reserves overnight. A higher Fed rate means more expensive borrowing, which impedes on the economic development of many companies, as banks themselves consequently raise the interest rates that is offered at. And a lower Fed rate means the opposite. Another indicator of an economy is its employment rate. This rate, heavily related to reports of new jobs being had, and the job turnover rate, which itself measures how often employees change jobs, simultaneously gauges the economic growth of an economy, the stability and security of an economy, and large demographic shifts in businesses and employees themselves in an economy, such as the shift to more automated production. Lastly, there is the Manufacturing PMI, or Manufacturing Purchasing Managers Index, which is a scaled indicator that ranges from 1 to 100, with 50 representing no change. It is based on a survey of purchasing managers of whether or not manufacturing factors such as new order values, production, employment, supplier deliveries, and current stocks of goods have improved, remain unchanged, or worsened. Additionally, it is based off of data from multiple industries, making it an effective gauge about sentiments in manufacturing and economic developments in an economy. Indicators are important for traders to gauge an economy and base their positions on. These economic indicators are some of the few most important and considered values that influence trader sentiments. Common questions and wanted videos in the comment section below. Like and subscribe.